Welcome you all to today's session with Dr. Alex Joyner from IFM Investors. Some have asked me how we ended up with such a well-credentialed economist to speak to the chamber. Alex and I fell into bad company together a number of years back when he was part of a European Australia Business Council delegation to Europe, and we hosted the delegation for a couple of days in Dublin. So unlike many of the other economists out there, Alex has first-hand experience with Ireland in a European context, and also has had experience of a chamber event in Dublin and lived to tell the tale. So we're very fortunate to have someone who's as well credentialed, but equally so as relevant and understanding with us today.
Thanks for that. Very appreciate the kind words, I guess. And yeah, it's my pleasure to be here addressing the members of the chamber. In terms of having ideas about the economy, I will share what best I know. Economists have spent a fair bit of time having no idea, to be honest, because the word that I'm sure many people have already heard so many times through this period is unprecedented. This is all unprecedented. This is not what was in my economics textbooks. It's not similar to any historic modern Australian precedent or global precedent. It's something that hasn't happened before, before the Great Depression. I guess Spanish flu is what people go back to in terms of a similarity, in terms of a pandemic, but it's certainly economies are vastly different, and the way it's transmitted around the world is vastly different. So we are all starting to get a better idea of just what is happening, but there still remains a huge amount of uncertainty around what will happen. And that's just the nature more of the public health crisis. So Barry is going to move the slides for me, and we'll just go to the first one, which is sort of just a summary of what I will be talking about, just how we're thinking about things and how we'll think about things after this pandemic has hopefully at some stage passed. Starting from sort of February, March, when we're sort of coming into this, it was very much, the pandemic was, I think, underplayed as a Chinese problem. This was sort of January, February. February was sort of when we first started to hear about it seriously, but Australian policymakers were still talking about the bushfires that impacted the East Coast in January and February of this year. It became clear it was going to be a global problem when China, took some pretty drastic action, and then we saw the spread of the pandemic much more globally after that, and that's when things really got, I guess, serious. The initial stages of what economists were talking about is that, this will sort of more or less blow over. We'll stop things, then we'll restart them. Australia's own Prime Minister, Scott Morrison, was talking about snapbacks. We will shut things down, get control of the virus will pass on, and we'll just turn things on again. And that's when economists were sort of toying with the idea of a V-shaped recovery. Now, a V-shaped recovery is not in prospect. The closest thing we'll see to a V-shaped recovery, ironically, is actually in China, where it can do a few more things that a centrally planned government can do that you won't see happen in advanced economies, at least. So we're not going to see a V-shaped recovery. I guess what we're hoping for is a sort of what economists would describe as a elongated U-shape. So I'll discuss the shapes that we think about in the best case going forward, but it's not going to be a V-shape. This is going to be around for a long time, and I don't think that's a surprise to anyone now. The good thing is monetary policy and fiscal policy has been very proactive to support economies and the people that have been dislocated within. economies, becoming unemployed or losing their employment and going to 0 hours and being stood down and these sorts of things. I think the bad thing around that is a lot of advanced economies were not well placed to do that. Australia was sort of in the middle there, well placed on fiscal policy, not well placed on monetary policy. But there are a lot of economies that have a lot more government debt, already have negative interest rates and QE programs and these sorts of things. So, it's all policymakers are being helpful in this, but really a lot of countries hadn't recovered even from the GFC. So even sort of that 12 years ago, policy hadn't recovered in terms of the amount of debt governments were carrying, and central bank policy settings had certainly not normalised. Then we start to think about just the global rebound and getting back to normal, and the debate is really, will we ever get back to a normal, or how we operated pre-COVID? And will things change? Is there going to be structural change and reform in economies that see things like the concept of global sovereignty, economic sovereignty, and do we need to have supply chains and manufacturing capabilities that are critical to the economy brought back? Can we rely on other countries, in particular China, to make the things that we need? Or do we need to actually think about that and see what's critical, get them made in countries that we have stronger relationships with? It's clear that the Chinese-Australian relationship is under a little bit of pressure right now. And we can ensure a little bit more stability in times where supply chain disruption might be prevalent, and that's a thematic that drops out of this instance, and certainly is a warning for the future. Just to start the slide pack, just to see where we are. We talk about case numbers, and we see it reported on the news all the time. Obviously we're getting a little bit more control of what's happening in Victoria and therefore Australia. But I think the Australian case is indicative of how the risk of second wave outbreaks is really prevalent. And we've seen prominent second wave outbreaks in the United States in particular, where numbers are astronomically high compared to what's happened in Australia and New Zealand. Australia and New Zealand have been extremely proactive in getting control of the numbers, and numbers that aren't relatively high when you look at the global context and you sort of go to those per capita measures. Australia's actually done relatively well, but it has come at an economic cost, and the numbers are still sort of edging higher. Curves have flattened in a lot of countries, but numbers are still edging higher. So the restrictive behaviours that are in economies will be around for some time yet, I would suspect. People talk about vaccinations, but then the flip side of that is just the difficulty in bringing a credible vaccination to market in such a short period of time. Now, I understand that we've got everyone globally almost working on this, but it still has to go through testing phases, and it still has to be administered to the population. So that would be something where some upside surprise might occur if a vaccination is reached earlier, but that doesn't seem to be a prospect right now. So just moving through the slide deck, this is sort of I sort of did a social media post. This is sort of the league table on the right-hand side there of just the economic impact that has been required to get control of the public health crisis. Australia hasn't reported its second quarter GDP numbers, neither has Ireland. Both those countries, funnily enough, see themselves relatively well placed going into this in terms of just what was happening with GDP growth. Australia had only a 0.3 percentage point contraction in the first quarter. Ireland actually made a small gain, 1.2%. But we saw, countries like Spain, European countries, France, Germany even, really taking a hard hit in the first quarter. And that's really where we saw the lockdowns hit first and hardest. And then they've followed up with even worse quarters, Spain going backwards 18.5% in the second quarter, the UK going back 20%. Australia is expected to go back about 6.5% in the second quarter. That's the RBA's estimate, the Treasury's estimate. That would be an extraordinarily good result. I think Ireland, in terms of the market forecasts and consensus forecasts on Bloomberg at least, slated to go backwards 11%. So obviously there's a pretty huge toll on economies, and it looks like in that top left-hand chart that there's going to be a V-shaped recovery, but that's not really how we talk about it. There's obviously going to be a rebound in growth. We don't know how much that's going to be, but it certainly doesn't get us back to where we were in level terms in the economy. And that's something that I'll explain in the coming couple of slides as we move through. And we'll go to the next one, Barry, if we can. This just puts what's happened in a global context and a long-term context. So the top left-hand chart there goes back to 1900, and we haven't seen a reversal like this in the global economy since the Second World War. And obviously there's good reasons for the Second World War seeing that contraction. The COVID reversal is almost 3 times what we saw in economic terms, the magnitude of what happened in the global financial crisis. And obviously, although Australia was relatively unscathed through that process, obviously the Northern Hemisphere was suffering a huge setback, and Ireland, the Irish economy, amongst those that suffered that setback. The other notable thing is that this is the highest proportion of countries that have been in recession at the one time ever. I think the number there is 93%. 94% of countries are actually in recession, so even greater than the Great Depression. So this is an unusually synchronized global shutdown, I guess. And to be honest, the uncertainty around the snapback is very, very high, and you can see that in the bottom right-hand chart. It's just a measure of global economic uncertainty in terms of how economists are seeing things and how uncertain they're seeing things. And that's why that bottom left-hand chart, you're always seeing economists now present a number of scenarios. The Reserve Bank has done similar, presenting sort of a baseline case, an upside case just for balance, but really for appearances, and a downside case. And all the risks are skewed to that downside around second wave outbreaks, et cetera, et cetera. So moving through again, just on the slides, this is what we talk about very quickly. This is sort of a bit of an economics 101 using some of the Australian examples and Italy. V-shape is on the left-hand side, and the V is, do we get back to the level of output? So we always see V's in growth rates, but what we need to see the V is in the level of output. A V-shape is not on the card, so it's not going to be like a 1980s style recession that took place in Australia, which is the middle chart on the left-hand side. It will likely be a U-shape, and we fear that it will be something like an L or W shape, which is something like what Italy experienced in the global financial crisis, where it lost a level of economic output, and that was almost permanent. It's taken more than a decade, which is outside the scale of that chart, to recover to pre-GFC levels. So for us, it takes a little bit longer. That U-shaped recovery is probably what's going to happen in most economies, but many economies will suffer these L or W-shaped recessions. I think the other important thing there is just the labour market dislocation. So economies tend to recover relatively quickly in terms of a time scale. 24 months, you can get back to the level of output that you saw before the crisis, assuming there's no setbacks. And in Australia, there has obviously been a setback with Victoria. But what takes a lot longer to repair is the labour market, and that's really the crux of things in the Australian context in particular, is that we will see things like job seeker, job keeper be a part of fiscal policy for a long time. And that's a point that I'll return to later. The government simply can't remove those things. Otherwise, it risks exacerbating the shock to the economy, and that would only be a downside for the economy going forward. Just moving through to the next slide. This is sort of the way that we describe the shapes and things like that in the economy. I've done a chart there of what happened to the average economy in the GFC, and you can sort of see that it took around about 21 months for the average economy to get back to sort of normal levels of output. Australia was unusual in that case. We were doing unusually well at the time. So we were able to sail through that. But what we're talking about here is, and what I've already shown on previous slides, is the recession will be one where there is a precipitous drop in the second quarter of this year, and we've seen that. There'll be a flat spot. Now, in Australia, that second, on the bottom left-hand chart, that second arrow, the yellow arrow, is going to be a little bit longer than we first thought because of Victoria. The recovery is not going to be as quick and as sharp as first hoped because of the setback in Victoria. Then we'll see a partial snapback, I guess, in the economy, but it's sort of nowhere near where we were. And obviously that's going to take a lot of time for restrictions to lift. And then we'll see a long grind back to some level of normalcy. That will be an extended period, I would suspect, in this case. So, we're talking here 24 months to 36 months, I think, to get back to, a level of normal output that we'd see in the Australian economy. Just moving through the slides again. This is sort of what's happened to date. These are some of the higher frequency indicators that we get on the global economy. So we've saw basically a collapse in what we call PMIs, or the sort of manufacturing surveys globally. That translates very much into global trade, and we've seen that come down quite significantly, at 17% down year on year already, and that's probably got a little bit further to go. Interestingly, for economies like Ireland, like Australia, services-based economies, or services at least, is where a lot of the growth was happening in those economies. They've been particularly hard hit. We saw that with the UK numbers overall for their economy, because they are so services based, going back, the better part of 20% in the second quarter. Now, that's why I think there's probably slightly more downside to the Australian economy than is being forecast, just because a lot of the growth in the Australian economy, a lot of the jobs that were being created in the Australian economy were services based. Now, manufacturing is a much smaller part of the Australian economy than services. So that's why I see that downside. But these measures have picked up pretty quickly on a global basis, which has been part of the positive outcome in terms of global manufacturing and services, but certainly not to the levels that we saw pre the crisis. And what you'll notice is on quite a few of the charts that I have, like the bottom right hand one, it's notable that the outcome for the first part of the year sort of breaks the scale. It ruins a lot of charts. Economists are pretty frustrated having to change all their scales on their charts because of just what's happened, again, being unprecedented. Moving through, next slide. This is what I was talking about in terms of the unprecedented response from fiscal and monetary policy makers. So really what was happening in the global economy is that governments were very much undergoing sort of not as much austerity, but certainly trying to balance their budgets or move their budgets towards a balance. Australia was certainly doing that and went very, very close to recording a surplus. It never did, but was at least projecting one, and the government was talking about a balanced budget. But that's all now ancient history. Governments have had to employ, most governments have gone between 5 to 10% of GDP in terms of the blowout to their budgets. Australia's been one of those. So that's obviously adding to the public sector debt, which was already very, very high. Now that's less in Australia, but certainly countries, the UK, the US, Japan is probably the standout there by far. That was really has I guess brought forward a debate around what is appropriate in terms of debt for countries, but also what else can we do to finance countries? And this is where, and there's usually an economics question at the end of these presentations on modern monetary theory, MMT. How do we need to finance governments going forward? And that's increasingly in the debate. The reason it's in the debate, for the second reason, is those bottom three charts. This is basically global monetary policy and where it is. Central bank policy rates are at zero or at as low as they can get, as low as central banks are willing to take them. Some are negative, some are zero, some like Australia at 0.25 because the central bank doesn't see negative interest rates being a positive for the economy. But certainly what we used to call conventional policy in terms of monetary policy has all been used. There's few central banks that have any conventional policy space at all. And it's very difficult to see how, at least in the near term, policy rates would go up. I suspect they'll be low for an extended period of time. This is 2, 3, 4, 5 years even. They'll be zero or negative. What the central banks have done to replace that is unconventional policy. And the middle chart there is G4 central bank balance sheets. So central bank balance sheets have basically expanded 75 basis points of GDP of those G4 economies. Now, to put that in context, the US basically expanded its balance sheet by about the better part of $3.5 trillion in the matter of a few weeks. It started in sort of the 23rd of March, where basically we've gone from QE1, QE2, QE3 after the global financial crisis to QE unlimited, or QE infinity is what people are calling it. So that has been supportive of economies, but it's really been supportive of financial markets. And that's why we sort of wake up to the news every morning that the NASDAQ or the S&P 500 in the US has pushed to new highs. It's because of that central bank basically being the provider of liquidity of first and last resort, and not having much appetite at all for letting companies or businesses of any magnitude fail. So it's been buying not only government bonds, it's been buying corporate bonds as well. So providing corporate bond support, and it's doing that across the board, no matter how big the company. So and that's generated some debate in itself whether the Fed needs to actually buy Apple bonds, so the bonds of the company Apple. Do you need to support a company that is doing so well and has a market capitalization that is $2 trillion? I would probably err on the side of they didn't really need to do that, but they've gone all out, and that stimulus will be there for an extended period of time. Moving on to the next slide. I guess the critique that many economists have around monetary policy is that it didn't get us to the goals that we wanted to get to before the crisis, so it probably isn't going to get us to the goals that we want to get to after the crisis. And that's particularly true in Australia. The Australian economy was pretty fragile coming into this crisis. Now we record growth, but it's what I would describe as poor quality growth. Australia wasn't able to get the unemployment rate as low as it would have liked. The central bank has failed for about 5 years to get the level of inflation it would like, and certainly wages growth has been something that has been pretty stagnant for an extended period of time. We've never really got momentum there. So it would be my argument that fiscal policy needs to do more, and it's not just fiscal policy. It is in terms of stimulus and adding money to the economy and adding transfer payments and these sorts of things. It's actually a reform agenda. Productivity was very poor coming into this crisis. We need to do things about productivity. The aging of the population, there's not much we can do about that. Investment in the economy was also another thing dragging, and that was very poor. Now, governments need to do more around these things because, as I've just described, central banks really can't do more. So the sort of the implication of this is that governments will need to manage the economic cycle more going forward than central banks have in the past. And the problem with that is that when I describe a central banker, they are an independent arbiter of their own policy. When I describe a fiscal policy maker, they're a politician. So the decision-making process is entirely different. And one is obviously subject to being voted out after 3 years in the Australian case. So moving through on the slides, this is just a sort of a download of just what's happening in Australia. As I said, the economy was pretty fragile going into this. We had poor productivity. We had a small business sector that was under pressure. Small business profits, as we measure them in the national accounts, had been negative for about 6 or 7 quarters going into this. So it really wasn't well placed. We're overly reliant on our population growth, population growth that is now evaporated. And we're over reliant on our exposure to China. And that obviously that relationship has changed. Our exposure to China, not just in a resources sense, which has always been seen as a positive, but in terms of services exports, which is basically education for international students, and the international flow of tourists. These have been seen as very much a tailwind, but now it's clear that it could be a little bit more fleeting than we otherwise would have liked it because of the increasingly sort of fractured nature of the relationship between Australia and our biggest trading partner. The rest of that slide is sort of just a summary of what's happening. I think that the biggest thing that's changed over, say, the recent month is just Victoria. And how that will weigh on the recovery. So the Reserve Bank was looking for that sort of 6.5% decline in the Australian economy, and then a rebound of sort of 5%, 6%. We won't get that rebound of 5 to 6% in that third quarter. Most people think that the Victorian economy will drag on the Australian economy to the tune of about 3.5 percentage points. So really a modest growth in the third quarter for Australia because of just the Victorian drag. Just moving through the slide deck, just to show you some of the things that the Australian government's done. The top level there is just fiscal support payments, and to the Australian government's credit, once the crisis hit, it did quite a bit. Now you can argue about whether some things were appropriate and some things went to the wrong places, etc., etc. But in terms of a fiscal support package, I think it has done relatively well, particularly things that were necessary to make this crisis not turn into something uniquely Australian and extremely bad. So what I'm speaking of there is that if the unemployment rate had risen to 10%, as most think it will, on the headline number, and people didn't have an income and didn't have adequate support, then we would see Australia's household debt problem. Australia's got a high household debt proportion to GDP. That would become much more problematic. So if you hadn't have the support for income for households ongoing, and then a little bit of understanding and forgiveness from the banks, this thing could have really rolled into something much more sinister for the Australian economy specifically, just because of those household debt levels. Now, that's why I would suggest that the government will need to keep these policies in place, but also I think the banks will need to keep their support in place, and they've seemed to communicated to APRA that they're willing to do that, at least for the time being. The other tailwind to the Australian economy has been superannuation early release. Now, you can debate whether that's appropriate or not. I'll give my view that I don't think it's appropriate. I work in the superannuation sector, but I'm pretty objective about this. I don't think it's really doing people any favours. And the reason I say that is purely financial. The government has told us it can borrow at 0.8 of 1% for 10 years. So why couldn't they support the household sector to the tune of 30 billion, what's super early releases currently at? Because those people are foregoing 5 to 7% returns until they retire. So undermining their own retirement incomes and having to provide their own safety net when really the government could have provided that safety net for little burden on the overall budget in the terms of things. The bottom two charts just describe monetary policy. Obviously, the Reserve Bank has undertaken to provide liquidity to businesses through the term, the TTF, the TTF, term funding, TFF, term funding facility. So providing cheap credit to businesses via the banks, and has also ensured that the 3-year bond rate, so that the area of the curve, I guess, that most businesses borrow at and lock in at, make sure that is at 0.25%, so the same as the cash rate. Now that's going to be in place for an extended period of time. Most people ask, can the Reserve Bank do more? Yes, it can. It probably hasn't got the appetite to do that right now. Indeed, over the weekend, Phil Lowe is much more interested in talking about fiscal policy than monetary policy, telling states to borrow more money and invest in infrastructure. But certainly the Reserve Bank can do more. That bottom right-hand chart just shows what they've done so far in Australia's version of quantitative easing, which is called yield curve control, which is basically keeping that 3-year bond rate at 0.25%. They've only spent $52 billion. Now, that's not much in the scheme of things. Like I said, Australia's central bank balance sheet is around about 15%. Even New Zealand's at 20% of GDP. A country like Japan is at 120% of GDP. So central banks can do a lot more. What the Reserve Bank governor has ruled out is things like negative interest rates, which is I think is a good thing, and intervention in the exchange rate. And the exchange rate's an interesting one because we didn't really get that tailwind that we normally get in recessions from a low exchange rate. Because our borders were closed and services sectors, exports have been a key beneficiary of the exchange rate being low. That wasn't able to happen, and now the exchange rate's actually bounced back to 72 cents or so on risk assets. And the Reserve Bank's relative optimism and willingness to rule out any further action. Most central banks are still at the phase of saying, we'll just do more, we'll add more. Reserve Bank of New Zealand's a good example of that, where they'll say nothing's off the table and we'll do whatever's required to keep the economy going. That's why you see exchange rates be pretty bouncy. Aussie Kiwi, as an example, has rallied pretty hard just because the Reserve Bank has been pretty measured in what it's done, even though it sounds like it's done a lot. Moving on to the next slide. This is just what's happened with the government's balance sheet, the government's spending. All the forecasts that it did in December in the MyEFO, so the mid-year economic and fiscal outlook, have been blown out of the water. Obviously, the cash balance, so the budget surplus, I guess, that it was trying to report has been blown up, and we won't recover from this for an extended period of time. This is decades long, and this is where you sort of get to some of the arguments around MMT that we could probably directly finance some of this without any negative consequences and relieve the burden on future generations and the current generation in paying a higher tax rate than it otherwise would have to get the budget back to surplus. It's probably uncontroversial to say that both sides of politics will in some way be fiscally conservative, that is to bring the budget back to some semblance of balance over an extended time period, but that is contractionary fiscal policy. So that's going to be a debate that we have going forward. And in the over the medium term, I guess in the near term, the government is only talking stimulus. The budget in October is probably going to foreshadow not only an extension of the JobKeeper allowance, but some sort of, I would suspect, tax cut for households to give households a bit more income than they otherwise would be getting. They're not getting it from wages, for example. So to give households a bit of a break there, and really, whether that becomes stimulus or just support is an open question. I guess there was a survey out yesterday from the ABS that shows that the vast majority of people that are getting stimulus payments or getting support payments are saving them. So saving them for a rainy day, I guess, or paying down their debt. They're not really going out to the shops to spend too much unless they have to. So they're saving, paying down their debt, or paying their bills. Utilities was the other one. So that's, I think the Australian household sector will be pretty cautious for an extended period of time. Moving through the slides and just getting conscious of time, this is just, I'll focus here on the right hand couple of panels there. As you can see, this is just a comparative slide between the COVID crisis and what the Reserve Bank's expecting, which is that red dotted line, compared to Australia's experience in terms of economic growth in the 1990s recession, the 1980s recession, and then the global financial crisis. So obviously a much deeper and longer experience this time round. But curiously enough, the bottom two charts do highlight the best labour market recovery that we've ever seen in terms of a recession, and much better than the 1980s and 1990s. Now, the reason why governments and the central bank can forecast this is, one, JobKeeper is meant to keep people attached to their employer, so it will rely on the JobKeeper allowance being there. That's another reason that gives me confidence that JobKeeper will be there. But the other thing is, we won't have population growth coming back anytime soon. It was interesting, the Reserve Bank omitted their population forecast this time around in their statement of monetary policy, so their economic forecast for August, because they just don't know. But what I do know, and what I know from our airport assets and things like that, is that airports aren't going to be opening up anytime soon. We'll be debating on how to open up states before we start debating on opening up ourselves to different countries, and obviously population growth is key in terms of overseas migration is key in terms of population growth and that labour market, those labour market outcomes. So if you don't have people coming in, you don't have additional labour market supply, so you're able to hopefully erode the unemployment rate from that 10% headline number. Now, just to explain that a little bit quickly, you hear all sorts of numbers now on the unemployment rate, the effective unemployment rate, what it is. 10% is the forecast for basically the headline unemployment rate. Most people know that the headline unemployment rate is now inappropriate to measure labour market dislocation, because people have dropped out of the labour market, but also because people have been stood down or are working 0 hours. So you could be technically employed, but you're working 0 hours, so it's the same as being unemployed, and you'll be on JobKeeper, et cetera, et cetera. So that is just a reflection of different labour market dynamics in this recession than other recessions. So the real unemployment rate's probably 13%, probably a little bit higher depending on how you calculate it, but it's much higher than what it currently is sitting at now. It's 7.4% on the headline number, slated to go up to 10%, but will go materially higher in my view. Moving on to the next slide. This is just some of the new data that I guess that we look at now as economists, is all this high frequency data. Google and Apple tracking where people's phones are, really. So it's a bit of an eye-opener from that perspective in terms of they know where you are all the time. But what we're seeing is that things have lifted in terms of people's mobility. Now, these charts are, people staying at home, but there's also retail and recreation workplaces and transit stations and these sorts of things, and how people have been shopping in groceries and pharmacies. So obviously we saw a big decline, followed by a gradual comeback as restrictions were lifted, but now we've really lost momentum in that. And that's what's problematic. We saw it in numbers today from the ABS on high frequency employment data, that we now get that we're sort of losing momentum. And it's not just in Victoria, that is across the states. We're starting to lose some of the momentum that we got because people are still behaving in a fairly cautious manner, and that's understandable. Moving on to the next slide, it's just a sort of a pretty Victorian-centric view of the previous charts. Obviously, this has been in response to the second wave, and you can see the size of the second wave. The blue bars are Victoria, the grey is every other state. It's really been a Victorian situation, the second wave, and that's why all these mobility indicators for Victoria are significantly worse than the rest of Australia. Retail, recreation being notably bad. And you understand that if you're in Melbourne like I am, and I'll go to the shops later today to get some food, every other shop is closed from hairdressers to Kmart to everything. So there's really no option to shop. There is a lot of online shopping at the moment as well, obviously. And this is going to stick around to at least September 13 for Victoria. And obviously, business confidence in particular has been hit hard in Victoria, that top right-hand chart. But oddly enough, in the latest consumer sentiment numbers, New South Wales has a lower level of sentiment than Victoria in the last numbers, which were August numbers. And that's curious, but it's almost a situation where at least Victorians have some certainty around, okay, well, we're in lockdown, but clearly people are behaving in a sort of almost a pseudo lockdown fashion in New South Wales, and fearing that there will be further lockdowns as more cases are reported, or if more cases are reported. So moving on to the next couple of slides, this is just the Reserve Bank's economic forecast for what they're worth. I'm sure they'll be revised. I'm sure they'll be wrong. Most economic forecasts are struggling to keep up with just the changes in what's happening in economies. And these set of forecasts, unfortunately for the Reserve Bank, were basically released the day after Victoria went to stage 4 restrictions. So what we're going to see is probably a little bit more prolonged time period in terms of the recovery, especially on things like real GDP growth. I guess what's concerning for most households is that bottom middle chart, wage price index, so wages growth, very weak for an extended period of time, well below average. That's probably the problem for households. The bottom right-hand chart, the top right-hand chart is what businesses are thinking, and that's sort of unsurprising that there's a tepid recovery in business investment, because obviously, to the disappointment of the Reserve Bank, businesses don't invest just because they can and money is cheap. They do so because they have a confidence in the outlook, and they think they can sell more product, and no one really has that confidence in the outlook. On to the next slide. Will things return to normal? The ABS is taking a lot of surveys. This one's a bit hard to read because I cut and paste these from the ABS website, and they're not overly helpful in their charts. But a lot of people are comfortable to go back to work, but they're not comfortable to get on public transport or an aeroplane to do so. So people are going to be very much cautious going forward for an extended period of time, and that obviously has implications for how we use roads, how we use airports, how we use office space. I think things are going to be different for an extended period of time. Now that will have positive implications, but also negative ones. But I think that just going back to normal is far too much to hope for. Even if we do get a vaccine, I think people will be still pretty cautious around how they behave. I was talking to someone from my own office, and it's just like, if we had have gone back as scheduled in July, that was the plan sort of earlier in the year. What would have been the reaction if someone had have, in your open plan office, had have sneezed? Does that send sort of panic through the office environment? So I think people are really grappling with some of the issues. Some of the other ones that have I know of personally is, I work in a 40-story building with 6,000 people in it. How do you get those people into that building with social distancing in a lift environment where you can only have 2 or 3 people in the lift at any one time? You simply just can't do that. So that's going to have implications, I think, over a protracted period of time. Moving through the slides, the business implications. Businesses are obviously very, very cautious and have had to be so, just because they don't have the cash flows coming through, they don't have the business coming through, and they won't have that in Victoria for a little while yet. So the whole business environment has slowed down. Again, the banks are forgiving small business loans, or not forgiving small business loans, deferring small business loans, which has been helpful. Governments have added support in that space, but I think that, again, that support will have to be there for an extended period of time. We're seeing a real slowdown in and grinding to a slowdown in the way businesses are operating. We see that in some of the Reserve Bank's sort of business transaction data. Business transactions have slowed down materially. The numbers there have sort of almost collapsed, and that's just an indication that businesses are much slower to pay. and are really trying to manage their cash flows and their, their costs in a much different way to try and cater for the uncertainty. Obviously, the big thing in Victoria was problematic is that, when we looked like we're opening up, businesses geared up. They added stock, they brought back staff, only to be told that that things weren't going to open up as they thought. So obviously, there's going to be some caution again around that when we start to open up in Victoria, at least going forward. On to the next slide. Just looking at just some of the problems that I referred to in the Australian economy going forward, and how we can rebalance. We've always had this commodity side. It's always been good to us for the most part. It's been good to us now. We do have an over-reliance on that. A lot of economists that are down on the Australian economy just call the Australian economy sort of houses and holes. We just have a residential construction side and a mining sector. It's always going to be a good thing, but I think the concept of economic sovereignty, if it got momentum, is really going to be focusing on developing new industry, sort of the high-tech medical, high-tech manufacturing side of the economy a little bit more, because that has really sort of wilted, and we've sort of let that happen. Hopefully, one of the outcomes of this crisis is that the government will focus a little bit more on developing new industries and allowing, at least a tax benefit and an investment benefit in new industries that hopefully would flow through to the superannuation funds, who have a large pool of capital to invest in these things. The other thing was our reliance on China. That's going to be, I guess, questioned. Has been extraordinarily good for us. We hope we can continue that relationship, but certainly there needs to be a greater effort with a more diverse range of trading partners. So we need to keep on going with free trade. European free trade agreement's obviously an important one. One with India would be important as well, just to keep the diversification of Australia's trade going forward and selling different things to different countries. If we're ever going to get this economic sovereignty idea up, we're not going to sell things to some countries for cheaper than they can produce them. That's China in particular. China can produce things much more cheaply to us. We need to produce things either that China can't produce or produce them more cheaply, or find other markets for them. So I think that's something we have to do. And then there's the perennial one for Australia, household debt to GDP. We're only going to be adding more debt through this crisis, funnily enough. For all you hear about falling house prices and property markets that have stalled, the Australian household sector as an aggregate has never deleveraged, and it's not deleveraging now. It's always going to be a drag on the Australian economy, and it's a very, very difficult one to solve in a way that is not, it doesn't have bad and negative consequences for the Australian economy. And then population growth. We've relied on population growth for far too long. We haven't kept up in terms of the infrastructure in our cities, and it's a lazy way to grow. So whenever you see Australian GDP growth rate of, say, 2.5%, what we're seeing before the crisis, you've always got to see that 1.5 percentage points of that was population growth. Purely our economy is getting bigger because there's more people in it, not because we're doing better, we're more productive, or even that economic policy is being effective. Now moving on to, I think it's hopefully the last slide. Some of the near-term implications is really what I've just gone through. There's no chance of a V-shaped recovery. We just hope for a U-shaped recovery where we can make consistent progress back to where we were. The point made there in the bottom left-hand dot points, policymakers will need to do better. Fiscal policy needs to do better. Politicians need to do better. This is not just money. This is reforms, and really there needs to be a lot more pressure on those policymakers to deliver in that sense. To take the advice of the Productivity Commission or previous tax reviews, the Henry tax review, to reform, for productivity outcomes, but for also for more efficient tax outcomes. And this includes not ruling out things that the government is always ruled out, like the GST. That's probably the big one. the cornerstone of any tax reform needs to be the GST. Longer term considerations on that right-hand side, we're just sort of speculating there on what will get momentum and what won't, but certainly, this COVID crisis has been of benefit to sort of the anti-globalization movement, particularly in the US. US-China trade tensions are still pretty high. I think they'll continue to be high. There's a lot of uncertainty going into the US election as well. But I don't think the US election will resolve those US-China trade tensions because the Democrats, if they did win, are equally as suspicious of the Chinese trade intentions, at least, as the Republicans are. I've already outlined that what's next for policy. It's all about fiscal policy. And then do we consider even more unconventional things like MMT? Australia's future relationship with China, it's become clear that, our largest trading partner is not our best friend. So that will have implications. The way we work and shop and travel are going to be changed, at least for an extended period of time, before we get back to normal. And then the last point there is more around the investment space and interest rates, is that risk-free rates of return in investment markets are going to be low for a long period of time. So this is basically saying bond yields are going to be low for an extended period of time, which is effectively saying swap rates, or the rates at which businesses borrow at and fix in their borrowing at, will be low for an exceptional period of time. Even the floating rate will be lower for an exceptionally long period of time. And, even the Reserve Bank in Australia are talking about it being years before they can even consider removing some of this stimulus that they've got in place. The risk is only for more stimulus in the near term, not less. I've gone over time. I warned Barry that would be the case, but I'm more than happy to stick around and take any questions anyone has.
Thank you very much, Alex. As you'd expect, a few of my contacts have decided not to use the chat and the Q&A, and have been texting me during the presentation. Thanks for keeping me on my toes. You know who you are. Advanced manufacturing has been talked about as a potential growth opportunity. But looking at your charts in terms of the discrepancy between, the services side of our economy and manufacturing, is advanced manufacturing a real solution, or is it a nice idea?
I don't think it's a solution. It is a nice idea and part of the solution, I think. We certainly need to bring some things back, particularly in the medical field, I think. But also, can we afford to lose some of the institutional sort of manufacturing knowledge that we've had? The notable one that economists talk about a lot is that we no longer build nor design motor vehicles in Australia. Now, should we retain that? If we lose that over a generation, can we get it back? There's a lot of issues around that. I know that the company that I work for, IFM, who represents a large pool of capital in Australia, is trying to push that narrative. Now, I'll be open with you. IFM is backed by the industry funds who try to represent what they call working people. A lot of these are in manufacturing. So we're trying to push that. We think it's good for the country. It's good for our members. And, I think it's going to be a necessary thing. It should be a situation where we don't have to worry about supply chains as much as we currently do, or, we really need to diversify those supply chains. But then you bring that back into the, we need to be able to export these things as well, because, Australia is obviously a small market for these things. So that's where the free trade side of it comes in a lot more, is that, what we couldn't do with the Australian motor vehicle industry is sell cars offshore. And then it turned out that Australians, preferred overseas brands that were cheaper and as good a quality. And that sent the industry out of business. We can't risk making those mistakes again. So we'd have to choose wisely. And I think, I wouldn't advocate subsidizing industries, because, that didn't work in the motor vehicle side of things. But certainly we need incentives for investment for the super funds in particular, because they're a very large pool of private capital that has long-term ambitions, long-term investment horizons. And that's, the patient sort of capital that we need to grow and foster industries so they don't have to go offshore and find capital elsewhere. So, I think it's very much part of the solution, and, it would serve the Australian economy well to be a little bit more rebalanced from the services side. Services growth has been quite narrow in terms of education, tourism, and healthcare, and a part of that is structural as well. It's not going to last forever. Particularly the healthcare side as the population ages. That's been the driver there. It hasn't been a cyclical response. So I think we need some of these more nimble sectors, cyclical sectors, and we need government support to get those going.
We had another question that came through from one of our members up in Sydney that decided to drop the shoulder into us Victorians today, Alex. With Victoria's continued lockdown and reliance on population growth to drive a lot of the Victorian economy, can Victoria catch up in that curve to recovery?
Probably not. No. Unfortunately, there are support packages out from the government. I think just off the top of my head, Victoria's population was growing at, I think it was 2.4% year on year. The Australian average was 1.5. So we're getting overseas migration coming to us into Australia, and people from other states looking for worse weather, I assume, or better coffee. I don't know. So it's been an enormous tailwind. And you look at the per capita numbers, Victoria very much behind in terms of those per capita growth rates. So how much GDP per person. And, it's putting a lot of pressure on our infrastructure. The company I work for owns Southern Cross Station. And that is a station that is groaning, or pre-COVID, was groaning under the numbers of people that were coming in using the rail system and slowing trains down. The anecdote there is, in Melbourne, you might be familiar, we have a city loop, goes around a circle and then goes out to the suburbs. Literally could not get people off the platform quick enough to allow the next train into the station. So slowing the entire system down just because the station's not big enough for all the population that has been using it. So, I would suspect the Victorian economy cannot catch up. Again, we don't have, we also are heavily reliant on things that won't let us catch up. So retail and tourism and education are very big parts of the Victorian economy. And they're not going to be opening up the same way. Population isn't going to be opening up anytime soon. So you've got a whole bunch of smaller sectors that are going to be struggling. And then the export side of things, the currency is back up to 72 cents. So not getting that tailwind either. So even if we did have some exports, they're not getting that currency tailwind. So yeah, it's a situation where Victoria is going to continue to deteriorate in any data that you see released for August, and then it's going to be a long way back, and I don't think we can catch up.
Western Australia seems to be, a state apart. There are those who argue that's not unprecedented. But talking to our members over in the West, they're saying, that their biggest inhibitors of growth are likely to be the availability of a labour force, and supply chain pressures with closed borders. If we retain these border controls into the new year, will we see another revision in those figures, or do you expect that it'll have a few months grace?
Look, the border closures are one of the things you worry about, because you don't hear any good anecdotes about them. It's like we've shut the borders and pretended that Australians don't go across them, sort of thing. Really, an impost to agriculture, I think, is the one in Victoria that you've heard the most about, is farmers not being able to, cross the border freely, transport their goods across borders, all these sorts of things. And that's obviously detrimental to growth. One of the big things that we count very, very badly, and we only try and count it once a year because of that, is intrastate growth, and the trade of goods intrastate. We know that when we get deliveries into our ports for IFM, that those goods go everywhere. So those supply chains are significantly broken when the states are sort of in this, it's almost a tit for tat, combative, we don't want the virus here situation, where they're sort of cutting off their noses to spite their face. And it's obviously something that could unduly affect the Western Australian economy. Now, Western Australia is also benefiting from other things. The relatively high iron ore price should be good for the Western Australian government, at least, and that should be able to add some support there. But yeah, the state-to-state situation is probably going to be a drag on growth, I would say, because it seems to me that to a certain extent we've lost sight of what we're trying to achieve here in terms of the virus. Do we want elimination, or do we want effective control that doesn't overflow hospitals? Well, I think a lot of state premiers have erred on the side of elimination. We don't want ever to see another case of COVID-19 in our state. And that's the way they've acted on those borders. So I see it as a downside risk among the many to the economic outlook.
Yeah, it was interesting in your figures to see the greater level of uncertainty in New South Wales, where it's almost that fear of what might happen as opposed to actually
Yes.
the reality.
Yeah, that was one thing that Westpac was surprised about. Westpac produced those numbers, and I talked to Bill Evans on occasion, and he was very surprised that it was almost like a fear of what you could lose rather than a fear of sort of the re-emergence of the virus, and having the certainty around that, for want of a better phrase. So it's also something that the Reserve Bank are looking at quite closely on are we going to lose momentum? I was speaking to the Reserve Bank's Chief Economist, Lucy Ellis, and it's really something that they're pondering, is that are people going to go back to the way they were behaving? Because that determines everyone's forecast. It determines their lower bound forecast as well, is that if people are just worried, the other thing that drops out, and it wasn't in those charts, but that consumer sentiment survey had an extraordinarily strong spike in what we call unemployment expectations, or people worried about their job security. And that was in Victoria, but it was also in New South Wales. So it is that fear that keeps people, if they receive a stimulus payment, that's that fear that keeps them saving it. Or, they save money, not spend it for that rainy day. And it's, Victoria's 23% of the Australian economy and 32% of the labour market. The New South Wales economy makes up the other 33%, so that's the other half, so it gets you to 55%. Even if those two states by themselves stagnate, then the Australian economic recovery really starts to struggle in those circumstances. So it will be interesting to see if the New South Wales levels of confidence don't rebound in the next quarter. It was interesting also that New South Wales businesses were more confident than consumers, whereas in Victoria both businesses and consumers were very negative on the outlook. So we'll see whether New South Wales businesses get more confident or less, or the consumers get more confident or less in New South Wales, and those numbers come out, I think, in the next couple of weeks.
Thank you enormously for taking the time to talk to our team today. It's been fantastic, and hopefully I see you somewhere in person in the not too distant future. Thanks, Alex.
Thanks a lot, Brian. And people can reach out to me on social media platforms, LinkedIn, Twitter. If you've got other questions or just want to disagree with me or whatever, I'm perfectly happy to to engage. I speak to most people, so always happy to answer questions if there's any other ones after this or any in future. I'm always happy to engage with the Chamber and its members.
Fantastic. Thanks, Alex. Have a good day.
Thanks a lot. You too.